price of oil in 2016 has really all been about OPEC and the drive mostly by Saudi Arabia in the earlier part of the year to pump as much as it wanted. Since then, the agreement to limit production has pushed crude up to 18-month highs. What about oil ETFs? Well, James Butterfill joins us now from ETF Securities. I want to take a look at 2017 in just a minute and get your thoughts on where the ETF market is going to go in the oil sector. But first of all, 2016, how do we assess what's gone on? What are the underlying stories in the oil price?
The oil price has been exceptionally volatile for one, and we can see that certainly in our fund flows. Investors have been taking advantage of that volatility, really being quite shrewd and buying at the low points and selling at the high points. At some points we've seen $400 million of inflows into our oil ETFs, only to then see that us lose that all at some point. So there's been a lot of trading in oil, but at the start of the year growth was very bearish. The world economic growth outlook was very bearish, but also people were quite concerned there was this massive supply glut and that would continue throughout 2016. The reality is that hasn't happened. We start to see the first time in 2016, for the first time for 3 or 4 years really, OPEC really changed their stance on this, trying to destroy the frackers in the United States strategy.
What has happened, my understanding is this year, is the futures markets, the price of futures have been pushed up over the spot price, or the current price in oil. Contango, I believe that is.
Yes.
What effect has this had on your outflows, on your flows within ETFs, and what effect has that had on the price?
Yeah, so the contango is brought about through a large amount of supply. If you have a lot of supply in the markets, you have to find somewhere to store it, and if storage is scarce, people tend to find ships, tend to store it in ships and things like that. It's very expensive. That means as an investor, let's say if you invested in oil at the start of the year, you probably have to shave around $5 a barrel off your investment just to break even. So contango is a problem. You're moving from one futures contract to the next, and it costs money to do that. But what's very interesting is into 2017, we're seeing that surplus, that supply glut, diminish and in fact fall into supply surplus, which could mean oil falls into backwardation, or at least the curve remains flat, which means actually that you won't have that challenge of having to shave essentially $5 a barrel off the cost, because storage costs will have fallen so much. And
backwardation is when the futures markets prices go under the current price.
Absolutely. So it's a bit of a strange phenomenon. In fact, you're being paid to own oil in that respect.
Yeah. Let's take a look as well at the price. If we can bring up the price of oil first of all, we can get a better handle on what's been happening. We can see since the beginning of this year that the rise that we've seen.
And this is to do with OPEC. OPEC has really changed their stance, and they want to cut supply. This is something they announced on the 30th of November. They also convinced non-OPEC members to cut supply too. So investors are suddenly waking up to the idea, in fact, we'll be moving into supply surplus by mid-2017.
So in terms of your clients, what's happening at the moment and your projections for 2017?
Well, that news from OPEC pushed the oil price up very strongly. And investors have been very shrewd, as they have been throughout the year. At the high points, they've been taking profits. But we've started to see inflows trickle in again now, as investors realise that actually the oil price could tick up further. At the moment, though, we are, until mid-2017, we think it's challenging for the oil price to rise above $55 a barrel. Whilst the current price is hurting OPEC nations at the moment, where the marginal cost of production is around $60 a barrel. In the United States, the frackers they're very supply elastic. In other words, they can turn a rig on within 3 weeks. A traditional rig might take 6 months to turn back on. So as the oil price hits 50, you see those rigs being turned on. So it's another supply element, which is just every time the oil price tests around $55 a barrel, there'll be abundant supply. So in other words, the US is becoming the swing producer of the world, and that will limit the potential upside. But come mid-2017, the demand will pick up further, and it might outstrip the potential supply you get from the United States, and therefore the oil price could rise further than, say, $50, $60 a barrel. So
going into 2017, what's the message?
Early on in the year, don't expect the oil prices to rally particularly strongly. The oil market will always be undercut by increasing supply from the frackers. But within the second half of the year, there'll begin to be a real supply problem. Don't forget, there's been $1 trillion of capex cuts in the oil industry. That will hurt supply. So we could well see, towards the end of 2017, oil prices test $70 a barrel.
OK, all right. James, thanks indeed for joining us. James Butterfill is from ETF Securities, taking a look at 2017 and the oil market.